In 1945, the World War II finally ended, and Europe lost most of its industrial power. Britain, France, and other colonial power were losing control over their colonies, and West Germany had to rebuild their infrastructure from the beginning. Thanks to Marshall Plan, the United States provided great support. But this made European nations increasingly dependent on the United States. They were no longer a powerful nation as they used to be, and American influence in Europe was growing stronger than ever. In 1956, Egypt, which recently gained independence from Britain, occupied internationally owned Suez Canal. Britain, France, and Israel formed an alliance to retaliate Egypt, but their plan failed at the brink of success as the United States intervened, along with the Soviet Union. Under the financial pressure from the United States, the war was stopped. This was unthinkable in the 19th century, but it showed how weakened European nations were. In the next year, Belgium, France, Italy, Luxembourg, Netherlands, and West Germany formed European Economic Community to help restoration of their nations from the war and recover their industry. However, its real purpose was allowing France to monitor West Germany's steel and coal production. The war was ended over 10 years ago, but there was still distrust among European nations. Interestingly, when Britain tried to join EEC in 1963, it was rejected, since Britain had privilege of Commonwealth and could import cheap goods and disturb European market. Furthermore, many leaders of European nations, including Charles de Gaulle, were concerned that America would gain influence in Europe through Britain in EEC. However, both Britain and the member of EEC needed a bigger market for their growing industry. European nations were losing their colonies and the influence over the world. With limited manpower, raw material, and market to consume their goods, their industry was losing its room to grow, and they were becoming dependent on American technology, products, and finance. Then something happens in 1971. The Bretton Woods system had collapsed. Under the Bretton Woods system, European currencies were pegged by US dollar, and US dollar was pegged by gold. So they had very stable value. However, as the US dollar was no longer pegged by gold, European currencies also lost its stability. As currency values became free-floating, there was a big concern that European nations devalue their currencies to discourage import and to promote export. This was fine when Europeans buy European goods, but importing oil was a totally different story, especially during the oil shock. Many European nations had to import oil, and high oil price could stop their whole industry. Devaluing currency became lose-lose game, and there was a need for a stable currency exchange system, or perhaps European currency. But the idea of unified European currency was too radical at the time. 2 years later, Britain joined EEC along with Denmark and Ireland. This meant a huge sacrifice for Britain, since they could no longer protect their industry, especially in the agriculture sector. But the referendum in 1975 showed that British people were willing to take the sacrifice. It also showed the complexity of British perspective on Europe. Harold Wilson, the Prime Minister of Great Britain, supported to remain EEC, but his party kept silence. While many of Labour Party members were not really sure if they could trust other European nations, Conservative Party officially supported to stay, but they were not so certain about how much Britain would rely on them. But there wasn't strict measure to enforce policies in EEC. For example, 270 lira was worth 1 Deutschmark in 1975, but in 1979, thanks to government spending, it needed 470 lira for 1 Deutschmark. This gave a big advantage for Italian products, especially fashion and luxury goods like Gucci, Versace, Prada, and Giorgio Armani, threatening products from France like Chanel, Dior, Louis Vuitton. Italian wine became cheaper than French. Furniture and machine parts also became cheaper than German ones. This made France and Germany feel uncomfortable. This problem was a major uncertainty in European economy, along with Cold War. As more members joined EEC, it needed more strict monetary policy to prevent a nation from devaluing its own currency. And there was a solution: the pegged currency system, meaning fixed exchange rate. When the currency were free float, the currency values are determined by supply and demand. So more money in the market means more money supply, and it usually means inflation. But if the currencies are pegged, any currency must be ready to be converted to other currency. So more money to market possibly meant more debt to pay in foreign currency. For this reason, European monetary system was introduced, along with its exchange rate mechanism, called ERM. It was basically a fixed currency exchange ratio, but the ratio could be changed up to 2.25%, except Britain, Portugal, Spain, and Italy. Since they have weak industrial fundamental, they are allowed to change up to 6%. In other words, it was prohibiting European nations to devaluate their currency too much. It turns out that ERM was practically pegging European currency to West Germany's Deutschmark. In the 1970s, West Germany had the strongest economy and the most export in Europe. As a result, ERM made the European currencies become merely a medium to get Deutschmark. Because of Germany's strong economy, there was no need for monetary expansion. Germany's inflation rate was low, and because of pegged currency, other European nations could not devalue their currencies, regardless of their economic situation. They were losing control over their own market. Meanwhile, Britain had been struggling in grim period at the time. More and more colonies became independent states, and it was losing its global influence. Oil shock brought the energy crisis, and British disease, which was caused by a strong British pound, devastated British industry. Britain even begged IMF for loans in 1976 because of high budget deficit. Margaret Thatcher, who became the British Prime Minister in 1979, refused to adopt ERM system. She was determined to revive British economy, and to do so, Britain needed unchallengeable control over British pound, while other European currencies were tied to expensive Deutschmark. However, many people who worked under Thatcher had a different idea. Nigel Lawson, the Chancellor of the Exchequer, saw the inflation rate was rising and thought pegging British pound to Deutschmark would solve the inflation problem. So in 1987, he pegged British pound to Deutschmark with between ratio 2.9 to 1 and 3.0 to 1 ratio without any official statement, and didn't even admit that he pegged British pound to another currency. This secret rebel was found by Thatcher in 1988, and it had to be ended. But there was another reason why he ended his secret policy. As financial markets globalized, American capital began to enter British market. As we saw from Plaza Accord, US dollar was getting weaker, and this attracted American investors to buy British pound, while overvalued Deutschmark was losing favor. To keep the exchange rate with Deutschmark, he lowered the interest rate from 8.5% to 7.5%. However, 1980s Britain had the most thriving economy in Europe, and economic optimism dominated the financial market. As the interest rate goes down, it drove buying sprees in Great Britain, which led inflation. As the inflation rate goes up, it was impossible to keep the exchange ratio 3 to 1, and Lawson's secret plan had to be ended. Lawson lost his credibility, and he was replaced by John Major, who was another supporter of ERM. Meanwhile, Margaret Thatcher was losing popularity, and she was even less popular than the party. Her combative personality created political enemies inside the party, and many of them wanted Great Britain to be part of Europe. To hold her seat as the Prime Minister, she allowed Great Britain to join ERM in reluctant. Unfortunately, her party betrayed her, and John Major became the new Prime Minister. The new Prime Minister wanted Britain to stay in ERM. He thought Lawson's trial version of ERM failed because it was unofficial. He believed announcing that Britain officially joined ERM would bring confidence in British pound, so the fixed exchange ratio could be maintained. But as Britain joined ERM, it showed immediate side effect. In 1990, German unification and the end of Cold War brought uncertainty in Europe, and Germany's Deutschmark tumbled. British pound was supposed to be more stable because of Great Britain's geopolitical situation, and Germany's crisis could have been an opportunity. However, British pound was pegged to Deutschmark, and British economy stumbled with German economy. When Deutsche Mark regained its value, 3-to-1 exchange ratio turned out to be too much for British pound, and people outside Britain began to stay away from British products and services. The industry was slowly dying and unemployment rate soared. Unfortunately, German reunification turned out to be more costlier than was expected. When West and East Germany unified, German government had to take care of their new citizens in East. They also had to repair outdated infrastructures and replace the old and soon-to-be worthless East Germany currency with their own. All this has to be done by government spending. And we know what happens when too much money from government flow into market. To prevent rampant inflation from government spending, German central bank had to raise the interest rate. In May 1988, German interest rate was 4.5%, but in 1992 it went up to 9.75%. Now, as the central bank raised the interest rate, commercial interest rate followed. Government bond, corporate bond, and mortgage interest rate all went up. Just like USA in 1980s, high interest rate discouraged investment and consumption and pulled money from market to central bank. German Deutsche Mark supply was dropped dramatically, and people now had to convert other foreign currencies to Deutsche Mark to buy German products. However, since European currencies were pegged to Deutsche Mark, banks had to convert their currency in fixed ratio, no matter how much German Deutsche Mark they have in foreign reserve. At this moment, Deutsche Mark could no longer work as stable currency that European nations could rely upon. And this caused great disruption in European monetary system. Many European nations demanded Germany to lower the interest rate, but Germany refused. Rumors started spreading, saying ERM would be soon collapsed. On Friday, September 11th, 1992, many investors and financial institutions converted Italian lira to Deutsche Mark in fear of Italy running out of Deutsche Mark or leaving ERM. Italy urged Germany to lower the interest rate, but Germany responded with lowering the interest rate only by 0.25% and told Italy they could no longer help. Without any other option, Italy left ERM. Italy just couldn't sustain the fixed exchange rate. Then, the world witnessed Italian lira plummeted and worried the same thing would happen to Britain. Although John Major assured Britain would never abandon ERM, but the world questioned British ability to maintain the fixed exchange ratio. But John Major was determined to stay in ERM. It was his decision to join ERM, and leaving ERM after less than 2 years was basically admitting that their economic policy was a mistake. Not only that, it was unsure that Germany would maintain high interest rate for a long time. He believed that Germany's high interest rate was not just monetary problem. For him, it was a diplomatic problem. However, there were some people who noticed the weakness in the British pound. They believed British foreign reserve was not enough to stay in ERM. And Stanley Druckenmiller, who was a hedge fund called Quantum Fund, was one of them. And he planned something to exploit this weakness with the chairman of the Quantum Fund, whose name was George Soros, and they decided to short British pound. So, what is shorting? Usually, profit comes from buying at low price and selling at high price. But this one is the opposite. Selling at high price at first and buying at low price later. And how do they do this? By borrowing and repaying. Here is what Soros planned. First, they borrowed massive amount of British pound and convert to Deutsche Mark. This will undermine British foreign reserve. If British foreign reserve depletes completely, then Britain cannot repay foreign debt, and impossible to import foreign goods, especially fuel, energy, and machine parts, which were essential for British industry. So Britain cannot allow foreign reserve to be depleted. The only option is abolishing fixed exchange rate, which means Britain has to leave ERM and let the value of British pound collapse. Finally, once the value of British pound collapses, Soros convert borrowed Deutsche Mark back to British pound in much cheaper price and pay back the borrowed British pound with some interest. George Soros was not the only one who saw the weakness of British pound. Many investors and financial institutions were already converting British pound to Deutsche Mark in fear of leaving ERM. On September 15th, German Bundesbank unofficially mentioned that British pound might have to be devalued. Later it was revealed that it was said in concern, not a demand or prediction or suggestion. However, this was more than enough to trigger the financial disaster. Next morning, British banks were astonished by the demand for foreign currencies worth for billions of pounds, even before the market opened. This was the moment that Soros had initiated the fight. The Bank of England foreign reserve began to dry in unimaginable speed. It had £19 billion worth foreign reserve, but no one was certain that its foreign reserve could survive in a week. At 11 AM, Britain raised the interest rate to 12% to cut down the money supply and defend the fixed exchange ratio. But this was too late. 2% change was too radical and it needed some time to see the effect. It only showed that the Bank of England was facing big trouble. It was seen as an act of desperation, and Soros bet against the ERM and the Bank of England doubled. More and more people joined selling the pound for other currencies. £2 billion worth foreign reserve evaporated in every hour. The Black Wednesday had started. But John Major was stubborn. Britain in ERM was his work, and he had no desire to abandon his political monument. At 2 PM, instead of giving up, he ordered the Bank of England raise the interest rate to 15% from 12%, which was announced only 3 hours before. However, this only showed the Bank of England was close to defeat. Around 3 PM, it spent £15 billion out of £19 billion. In a desperate attempt to stay in ERM, Major demanded Germany to lower the interest rate. However, Germany refused his demand. Without any allies, the losing battle could not be won anymore. After the market was closed, British government officially announced that Britain was no longer in ERM. And as the fixed exchange ratio collapsed, the British pound plummeted. Soros then sold the Deutschmark and repurchased British pound, which became much cheaper, gaining billions of dollars worth profit. The initial aftermath of Black Wednesday was devastating for Great Britain. British pound plummeted 15% and created uncertainty in British economy. However, its political impact was more significant in long term. It reminded them how dangerous to rely their political, economical, and financial decisions to other nations. It proved that European nations, especially Germany, were too self-interested, stubborn, and unpredictable to be considered as partner. Their suspicion on Germany worsened in 1993 when France faced similar crisis. Germany allowed to France to devalue their currency up to 15% so they could stay in ERM. As British economy recovers, it proved that Britain didn't really need European currency. Britain enjoyed relatively thriving economy while Germany and other European nations were struggling. As a result, Britain stayed away from Eurozone and became a major European nation that does not use euro currency. Separated by currencies, Britain's finance, economy, and industry kept its distance from other European nations, and only European regulations and traditional faith in Europe kept Great Britain from leaving European Union. As a result, in 2016, many British people thought the European Union as a burden, not as privilege. Meanwhile, Soros rose as the rising star of Black Wednesday. He showed a mere hedge fund could defeat a developed nation, and became main antagonist in many conspiracy theories, often described as the head of a secret global organization. After all, such reputation would only help him as a hedge fund manager. He showed valuable lessons for investors and financial institutions. Unfortunately, many politicians around the world, especially in Asia, didn't expect the same thing would happen to them. And 5 years later, they learned this lesson in the most expensive way.